What's up everyone, my name's Robbie, this is Robbie in Manila, and today we're talking about mutual funds, index funds, and ETFs. So I actually have a lot of experience talking about the difference between all these different instruments because I used to be a financial advisor and I talk to clients about this stuff all the time. I'm going to be going over this in really a simplistic way that anyone's going to be able to understand, and there's two main things I want to get across. So the first thing is I want you to understand, of course, what's the difference between a mutual fund and index fund and an ETF. And then the second thing I want to get across is really which is going to be best for you. So you with your unique needs, what is going to be the best vehicle for you to invest in? So anyway, enough of this intro, let's go ahead and let's get started. Okay, so before we get started, there's something that I need to get out of the way, and it is that, well, I think the YouTube algorithm hates me. And if you would hit the like button, I think it might turn the table. It might start liking me somehow. So if you were to hit that like button, seriously, I would very much appreciate it. So thank you for that. So mutual funds are like the OG of these three different vehicles. They're the oldest, and they actually go back to like the 1920s. So they've been around for really a long time. Now, mutual funds are a way for you to kind of invest your money into a pool of money. So when you put your money into a mutual fund, it's pooled together with everyone else's money. And so what happens is there's a fund manager or a team of fund managers or a team of people that are involved with finding stocks and maybe bonds or maybe even other things like commodities depending on the fund, and they figure out what to invest in. And they try to invest this big pool of money, which your money is a part of, and your money grows as the pool of money grows, and it shrinks if the pool of money shrinks. So to better understand mutual funds, let's think about back in the day, like why were these things created? Like why were they necessary? So back in the day, think about how you would be able to invest your money. So maybe you could buy individual stocks. Maybe you could buy individual bonds. Maybe you could buy real estate, and maybe you could invest in gold. But besides that, how else were you able to invest your money? Maybe you buy art, or hey, maybe you invest in a Scotch collection. So you have these few ways to invest your money, but access to things like stocks and bonds, and let's say Wall Street in general, they're really reserved for people that are higher net worth people. They have more money. So the average person in this world wasn't able to probably buy stocks on the stock market in the NYSE back in this time period. So there's no TV. You can't watch what's going on in the market during the day. There's no internet, so you can't see what the prices are right now at this moment in time. So what you have to do is you gotta go look at the newspaper, and that's the day after. So you would see all the different stock prices in the newspaper. And the other way to do it is to have something called a ticker tape machine. And so you've probably heard of a ticker tape parade before, and so this machine, it would spit out the stock prices during the day. That's the only way that these Wall Street firms would understand or know what's going on in the market at that point in time during the day. So normal people don't have access to this. So interesting history fact, by the way, is that the first ticker tape parade happened when the Statue of Liberty was dedicated in 1886. So this thing goes back a long time. And so anyway, okay, that's like the history of mutual funds. So there's tons of different fund companies that you've probably heard of. There's Franklin Templeton, there's Vanguard, there's Fidelity, there's T. Rowe Price, and then there's also large banking institutions that you've heard of like Morgan Stanley and JP Morgan. So all of these companies have some type of mutual fund available for their clients. And so of course, one of the best things about mutual funds is the fact that you get diversification, that you don't have to invest all of your money into just one or two or three stocks. You have this fund that invests in a bunch of different stocks. Now I know you're probably thinking, wow, these mutual funds sound so great. I get diversification, I get access to a portfolio manager. I can hopefully have a great return because my portfolio manager is going to do a great job and make a lot of money. Now before you go down this mutual fund route, there is something that I think you should know, and it is that these days, comparatively speaking, mutual funds have high fees. So as you know, I used to be a financial advisor, and back in the day, I would open up funds for people and I would get paid as a financial advisor. So let's go over an example. Let's say I opened up an American Funds mutual fund for a client. The fee that would have gone to me could have been as high as 5.75%, which is something called an upfront load that would go straight to me as the advisor. So looking back, I now understand that these fees, I mean, honestly, they add up to a ton of money. And if you compare this to the fact that fund managers on average don't actually beat the market, then it's really not a great place to put your money. So in 2019, only 29% of active fund managers beat their benchmark after fees. I mean, it's abysmal. It's terrible. I mean, that's not good. Okay, that was mutual funds. Let's now talk about index funds. So index funds try to track an actual stock market index. So what is a stock market index? You may have heard of something called the S&P 500. Maybe you've heard of the Dow Jones Industrial Average. These are basically baskets of different stocks, and then people try to use them as benchmarks and try to beat those benchmarks. So for example, I try as an investor, when I invest in different stocks, I try to beat the S&P 500 index. That's my benchmark. So that's how I tell if I'm actually doing good when I'm buying stocks. And so if you're not someone who's trying to buy individual stocks and beat the index, then you might want to just track the index. So if you do exactly what the index does and you don't try to beat it, then you can go ahead and invest in an index fund. Essentially what you're going to get is the diversification that's associated with a mutual fund, but without the fees. Okay, so to kind of understand this, let's take a look at a Vanguard index fund versus an American Funds mutual fund. Okay, let's take a look at this analysis. So on the left side, you have the Vanguard Total Stock Market Fund, which is Admiral shares. On the right side, you have the American Funds American Mutual Fund, which is a Class A share. Okay, so what this is showing us is if you invested $10,000 in both of these funds and you made 8%, so you invested the same amount of money, you made the same exact rate of return, what would you have in 10 years? And so the answer is, if you had the Vanguard Total Stock Market Index Fund, you would have $21,503 at the end of 10 years at 8%. Over here, you would have, with the American Funds Mutual Fund, which has higher fees, you'd have $19,143. So why do you have so much more money in this Vanguard fund than in this mutual fund, if they both have the same rate of return and the same amount of money in the same time period? Well, the answer is the fees. So here you can see it's only $60 for 10 years to invest this money. That's how much you had to pay Vanguard. $60. It's crazy. Now go over here. How much did you have to pay American Funds? Well, $1,411. So they made so much more money on your money. And again, like we talked about before, the fact is that they probably are not going to be able to consistently beat the market or the benchmark. So why would you put your money with American funds when you could just invest in this index fund? Now, this isn't even mentioning the fact that some mutual funds have something called a contingent deferred sales charge, meaning that if you take your money out before, let's say, a year, they may actually charge you an extra fee, so your money is less liquid. Okay, hopefully you understand now that mutual funds are way more expensive than index funds. Index funds just track a market, but mutual funds, there's a good chance they're not even gonna beat the market anyway, so might as well track the market with an index fund. So let's go ahead now, let's talk about ETFs. From a consumer perspective, ETFs and index funds, they're almost identical. You can almost not tell any difference whatsoever for the things that matter. So they both give you diversification. They're both extremely low fees, and they can both track an index. So one thing that's gonna help you understand the differences between these two things is where your money goes. So when you put money into an index fund, it goes into, let's say if you buy an index fund with Vanguard, your money goes into a pool of money in Vanguard. It's sitting inside Vanguard. But if you go and you put money into a ETF, you're actually not putting your money into a pool at Vanguard, you're actually buying it off of the stock market. So there's an ETF that trades all day on the actual New York Stock Exchange. And now because the ETF is trading on the New York Stock Exchange on a daily basis, you can buy and sell it and do what you want with it. So you could literally trade an ETF during the day. You could day trade it if you want to. You could buy it at 12 o'clock, you could sell it at 1 o'clock, you could buy it again at 2 o'clock. So that's a more liquid way of investing, an ETF. So while ETFs have more liquidity and they can trade more quickly and during the day and things like that, they're not that much more liquid than index funds. I mean, you could sell your index fund and probably distribute money within a day. So that's not a big deal. It's not like a mutual fund where maybe your money is locked in for up to a year. And to show you just how close these index funds and ETFs are from a return perspective and from a fee perspective, let's take a look at an ETF and an index fund and compare them. So here we're looking at an ETF and an index fund. So on the left side, you have a Vanguard ETF. It's called VOO. That's the ticker symbol. VOO tracks the S&P 500 index. Now, VFIAX is a index fund with Vanguard, and that also tracks the S&P 500 index. They do the same things. So two main things that we want to see here is what's the expense ratio? So how much money does VOO cost versus VFIAX? So we can look and we can see that VOO is 0.03%, VFIAX is 0.04%. So there is a difference in the cost, a very, 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 very small, almost insignificant amount of percentage, but yes, it's a little bit more. In the long run, it will probably have almost zero effect on like the amount of money that you're gonna have. 0.01% is so low, but it'll have a very small effect. And then the other thing is there is no minimum to have this ETF. So to have VOO, there's no minimum. But to have a VFIAX, which is something called Admiral shares, then you do have to have a $3,000 minimum. Now, you can have a non-Admiral shares, but then you're gonna have a little higher of a fee if you do. So the 0.04 is a lower fee because you get the Admiral shares. Okay, so we can see that an ETF, in this one at least, is a little bit less expensive than the index fund. So you might be asking yourself, okay, well, what is the returns though? Are they the same? So I got this information from the prospectus of the ETF and the prospectus of the Vanguard index fund. So you can take a look and you can see the return before tax for VOO. The 1 year return here is 31.46%. For the ETF and for the index fund, it was 31.46% also. By the way, these are 2019 1-year returns. So then if you look at the 5-year return, it's 11.66% for the ETF, and it's 11.66% for the index fund. So the exact same returns. So that's the return before tax. Now if you look at something called the return after tax on distributions, it gets a little bit different, but honestly it's almost the exact same. So this return is 30.83%. This is 30.82%. So again, 0.1% difference. It's so minimal, it's almost not even worth even mentioning, but there is a little bit of a difference. And then if you look at the S&P 500 index, how much did that return? Because remember, the ETF, VOO, is supposed to track this S&P 500 index. And VFIAX is also supposed to track the S&P 500 index. So the S&P 500 index had 31.49% rate of return over 2019, the year of 2019. Now, the return before tax, 31.46%. So almost the exact same. 0.03% was the difference there. So as you can see, they almost track the index perfectly. If you look at the 5-year, it's the same thing. The S&P 500 index, 11.13% return after tax on distributions, 11.70 was the S&P 500's return. That's for VOO, okay? So you can take a look and you're gonna see some very similar things. Now this one is in the prospectus, but you almost don't need to care about it. This says return after tax on distributions and sale of fund shares. So you'll see this in the prospectuses when you're looking at the rates of return. The main thing about this is it's assuming that if you sold this fund and then you were in the highest tax bracket, then how much money would you have made as a return? But of course, you probably would have different tax brackets. You might not have sold it. So this is almost not even worth having in here, but I did put it in because it's in the prospectus and you might see it if you ever look at prospectus. Wrap this all up here. The VOO ETF and the VFIAX index fund have almost the same return. One has a little bit more of a fee. The index fund has a little bit more of a fee. and they both track the S&P 500 very closely. Okay, so you got ETFs, you got index funds. So now you're probably wondering which one should you yourself invest in? Which one should you use? And so I'll tell you what I personally like for myself. I would prefer to have an ETF over an index fund generally. And so we kind of saw that the ETF with Vanguard, the VOO, was a little bit less expensive than its counterpart index fund. And so this kind of happens a lot with some of the different fund families. And if that's the case, then I would always prefer to have a little bit of a less fee on my ETF than the index fund. I don't see a reason to pay a little bit more, even if it's 0.01%, it's so small, but I still don't see a reason to pay a little bit more to have money in an index fund over an ETF. Then you add in the fact that the ETF is more liquid than the index fund because I can trade the ETF if I need to, or I can get out in the middle of the day if there's some type of crazy, stock market crash. So at least I have that option of liquidity. So there is one more thing I think is kind of important to mention when we're talking about ETFs versus index funds, and it's really the fact that there is a bit of a taxation advantage, although it's not huge, in ETFs. So really what happens is ETFs have a little bit more taxable favorability, or actually you might say they have a tax loophole that allows them not to basically pass taxes on to you or me, the consumer, but that's not always the case in index funds. So sometimes you'll look at an index fund, let's say at like a Fidelity or something like that, and then you'll look at its counterpart, ETF, and you'll see that the taxes on the index fund are a little higher than in the ETF. And so that's just one of the other reasons why I do like to have the ETF over the index fund. Oh, there is one more thing that I do think is kind of important, and it's the fact that ETFs don't always track an index. So, of course, there are ETFs like VOO that we talked about that track the S&P 500 index, but there are other ETFs that don't track an index. So there's something called momentum ETFs. So they are a proprietary ETF that tries to only invest in stocks that are experiencing momentum. And so that's just an example, but there are other ones. And so basically, ETFs don't always have to track an index, but index funds are very much usually track an index. Okay, so that's all we have for this video. I hope you understand now the difference between mutual funds, ETFs, and index funds. And by the way, leave a little comment and let me know which are the ones that you're investing in. And if you want to see more videos like this, please subscribe to this channel. And if you like this, again, I would love if you hit that like button because it really helps me out, and YouTube hates me right now. So make YouTube like me. Anyway, so thanks a lot for watching, and hopefully we'll see you in the next video when you click it on the end screen right now.